Hello and welcome to another deep value video. Today, taking an in-depth look at Cisco systems, ticker symbol CSCO. We'll dive into financial metrics, the company's growth, and ultimately try to find its fair buy price. Cisco Systems Incorporated, using the trademark Cisco, is an American multinational digital communications technology conglomerate corporation. Cisco develops, manufactures, and sells networking hardware, software, telecommunications equipment, and other high technology services and products. As of the 30th of November 2024, the stock is priced at $58.7 with a market cap of 244 billion. Now let's dive into some key valuation metrics. The price to earnings ratio stands at 23.1 and the price to cash flow ratio is 21.5. The median PE over the past 10 years was 17.2, so they are trading above the historical average. Over the past 5 years, the company's revenue has grown by 9.1% and its bottom line has decreased by 8%. In terms of earnings per share, there has been a decline of 3.8%. This is due to the number of common shares outstanding, which is 4.06 billion, declining by 4.5% over a period. Now let's assess the company's liquidity and solvency. The interest coverage ratio is 13, indicating the company's solid ability to handle its debt obligations. The quick ratio, measure of the company's short liquidity, is 0.83. This is not great, this is not horrible, it's about in the middle, in my point of view. Additionally, the long-term debt equity ratio is 0.43 and the total debt equity ratio is 0.68. This suggests a moderate debt load. Shifting to the cash flow statement, cash from operations stands at 10.9 billion, reflecting a decrease of 29.5%. Cash from investing activities is minus 20.5 billion, with a minus 685% change, while financing activities are at 6.8 billion, showing a minus 146.3% change over the same period. CapEx has decreased by 13% and free cash flow has decreased by 30.3% to 10.2 billion. Moving forward, let's look at the return metrics to see how well the company is utilizing its resources. The return on equity is 22.6%, the return on investment is 20.7%, the return on assets is 9.2%, and the return on invested capital is a respectable 11%. Finally, let's find the acceptable buy price. The first method is conducting a discounted cash flow analysis. By using a discount rate of 9%, a revenue growth rate of 2% for 10 years, and a perpetuity growth rate of 1%, we get a fair value of $45.89. Secondly, using a multiples valuation of 20 times earnings, operating cash flow of 25 times free cash flow, we get a fair value of $57.69. Finally, the next price target is $58.64, and putting it all together, we get an intrinsic value of $54.07. Using a 15% margin of safety, we get an acceptable buy price of $55.96. Just another stock that Economist is overvalued. To wrap up analysis, I rate Cisco as a sell. Now, you will have noticed by now that the acceptable buy price is not really that far from the current price. And why do I rate it a sell and not a hold? Well, this is a very low growth stock. They're trading at 23 PE for a company that is growing at 2%, whose net margin is decreasing, their free cash flow margin is decreasing, their whole business basically is a swamp, and they do not deserve these valuations. Now, I use 20 times earnings, operating cash flow, 25 times free cash flow in my multiples valuation because I wanted to show that even with high valuation multiples, even with the analyst price targets, which are absurd, they are still overvalued. Uh, Now, if you believe that their new products or they'll have a new product to launch which they'll propel their growth, I don't know, a let's say a miracle product, a miracle coming out of their labs, then sure you could invest in them, but they're literally growing at 2%. This is less than inflation. In the past 5 years, they've literally grown less than inflation. And if you take their net income and include inflation, they've not only decreased by 10%, by 8%, they've probably decreased more like 20 something percent their net income, including inflation. So this business is definitely something which I would not even touch with a 10-foot pole unless they decreased, unless the price dropped to very much lower levels than today. I'm not sure what you see, what people see in Cisco if when they invest, but a dead company, a very mature company with a non-existent growth rate that is trading at above historical averages in terms of price to earnings and price to cash flow. I'm not sure what you could see in this, but if you want to invest, sure. Of course, as always, do your own due diligence. This is not investment advice. Uh, this is just my opinion. Now, as for when this would be a buy, I'm not really sure. Probably sub 35, sub 37.5 levels, somewhere around there. I think that would be an acceptable buy price. Now, thank you for watching. If you found this video helpful, please like and subscribe for more detailed analysis. And also check out my new investing blog featuring in-depth analysis from the link in the description below. See you in the next video. Bye.